Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today we have with us this very special guest, Neil Parekh, Chairman and CEO of PPFAS Mutual Fund. And we are going to discuss everything markets, the valuations, if they're really expensive currently, the recent corporate earnings, the best approach for the markets at these levels, if any sectors are still attractive. Neil, of course, has spoken about the frenzy in thematic funds, so we'll try and explain the risks and opportunities there as well. All this and much more in the next 30 minutes. Neil, welcome to the show and thank you so much for joining us today. And at a time, we are seeing a lot happening in Indian and global markets, right? So what are you making of the markets right now? Earnings done for Q1, RBI sounded hawkish this time. We have a lot of geopolitical issues. What's your sense?
Thank you, Sonal, for having me over. Honestly, the last few years, the markets have been on a one-way trend upwards, So I think we've all been happy with that, a lot of investors, asset managers, everyone has been pretty happy that markets have done really well for us for the last few years. Now, I think it's a bit of a time to be a little cautious now because markets are looking slightly more expensive. Also, valuations are not that cheap, and a lot of we're not getting too much valuation comfort, to buy new stocks. So obviously, the last few months also has seen a lot of news flow in terms of elections or geopolitical events and stuff like that. So which has kept the markets quite volatile and on the edge. I see that will continue to happen. I think markets will probably be quite volatile going forward also. At us at PPFAS, what we've been doing, I think our portfolio has been more or less stable only. We've been actually cutting positions wherever we're seeing excesses or overvaluation and adding wherever the sectors or stocks have been neglected. So we're being a bit cautious right now.
Okay, all right. So a cautious stance coming in from PPFAS Mutual Fund. Despite that cautious stance that you are talking about and markets going one way, what's happening in the markets right now, especially in the mutual fund industry, is thematic funds. They are still in vogue. Sectorial funds are now 14% of total equity AUM. First, why are generally all the other AMCs showing so much interest here? And second, what is your advice to investors in this case?
Yeah, so what had happened a few years back, we had a scheme categorization circular that came, So basically what it said that a fund house cannot have more than one scheme per category. Before that, before the circular came, mutual funds were allowed to launch as many schemes as they wanted in as many categories, But that came to a standstill a few years back in, I think, 2017 or 18. Thereabout. So if it's a flexi cap category, a fund house can only launch one flexi cap fund in that category. Now, so most of the categories you can only launch one scheme, but there was an exception made for thematic and sectoral fund, where there's no limits to how many schemes or how many themes or sectors you can launch. You can launch mutual funds in, So obviously, I would think that's one of the reasons why people or mutual funds are launching a lot of thematic and thematic funds and sectoral funds is because that's the only place they can launch more funds, Also, at the time when markets are going up quite frantically, then there's greed in the market. People are wanting to invest in newer things. The overconfidence is pretty high. So I feel like most of mutual funds are launching right now because it can lead to higher AUMs. The other reasons why sectoral and thematic funds are in vogue is because every time you launch a new scheme, you can charge higher and higher fees on those new schemes, because as the fund goes larger, you have to bring down your expense ratios. But in a new scheme, you can charge top dollars for that or the highest expense ratio. As such, you can also pass on a higher commission to the distributors, So the whole ecosystem works well in that way, in the sense that everyone is happy. The AMCs are happy, the distributors are happy, but I'm not too sure about retail investors investing in narrower and narrower themes. I think investors should really study these funds and these what are the new NFOs are coming. I mean, it's always good to look at newer things, but don't be swept away by them. Be pretty careful about what you're going to be investing in. Don't let your greed or the FOMO get in the way of you investing into things that really don't make sense for you. So more or less, I would say that most of these schemes can be avoided. Stick to your asset allocation.
FOMO is the key word in the markets that we are in right now, and that's the reason we are seeing that big surge in inflows coming in from thematic funds, ultimately leading to those flows in equity funds as well. And while we are at those flow number, we're talking about record high gross SIP inflows. But if we talk about the net and look at the internals, as a percentage of gross SIP collection, it declined to an 11-month low, 40%. This is the number as of June. What is explaining this? Redemptions are still at a higher level. What does it talk about the market texture in that case?
Yeah, so I think first of all, SIPs are great ways to invest in the market. It's a very disciplined approach to invest in the market. When the markets are high or the NAVs are high, you get lesser units. But as the markets fall, the NAVs go down, you get more units. So I'm quite disappointed to see that SIPs have stopped or people are pausing their SIPs because of the market volatility or trying to time SIPs. I think that's a extremely bad idea if people are trying to do that. The other thing is that, so one is obviously the SIP stoppages probably are because of market levels and the volatility I just spoke about in the last 2-3 months. That's leading to that. And also there were some KYC issues were there, in terms of getting your KYCs, and if your KYCs were not done, then that would stop your SIPs automatically. So a combination of these two, I feel, has led to an increased number of SIPs to be stopped. Again, I am not. I think, like I said, the markets are quite have gone higher in the last few years. And if people do need money in the next 1-2 years, or they have expenses, or they want to profit book to buy a house or what have you, whichever goal you have, I'm okay if they redeem some from their corpus, but I think stopping SIPs is not the answer. Maybe a redemption would be a better answer. So I would urge people not to stop their SIPs and let the SIPs continue, because that's a very good disciplined way of investing in the market.
No, totally take your point, and it keeps you in the habit of investments and not so much expenditure otherwise. Since we are talking to you, we have to talk about PPFAS Flexi Cap Fund, Neil. This has been an outperformer and every investor's favorite as well. What has been the strategy here? Are you looking at some changes in the fund at the global level, considering geopolitical risk and the volatility that we are seeing in the markets right now?
Yeah, so I think what has helped us is just the consistency and the disciplined way of approaching, I mean, we've been doing this for the past 20-25 years, earlier in the PMS avatar that we had, and now in the mutual fund. So I don't think there's any change to our investment strategy or philosophy in that way, So I think also having a very transparent communication to the unit holders has really helped us, in terms of getting sticky investors in, where they really know what we are trying to do, and we try to communicate exactly exactly about what's happening in the fund. So I think that's helped people to stick around, and I feel in the markets, I think just having a long a time horizon automatically will make you make some decent amount of money, and power of compounding can work for you. The other thing is that we've never just chased fads and fancies of the market, and we always look for neglected sectors or stocks to invest in, So that's been kind of the approach we've had. It's a bottom-up stock picking approach where we look at management quality, valuations, business performance, business metrics. Again, is the company very leveraged or is cash rich? Do they have a competitive advantage around it? So these are the things that we look in a company. And obviously, if all these are there, and if the valuations, the starting valuations are very important to invest in. So that's the discipline approach we've got, which has helped us so far, So yeah, so nothing really changes in terms of our fund philosophy or investment style as such.
I ask you because it has been one of the favorites when it comes to investors. Just look at the way the returns have been. Since inception, it's almost been around 680%. In last 10 years, 430%. 5 years, 218%. So if you're talking about numbers like this coming in from just one single fund, do you think there's still more room for growth from here on in terms of returns? Any churn you're planning to ensure that the outperformance continues, because the market has changed a lot since then?
Yeah, so like I said, we are being cautious right now in our approach to these markets. So it's not a market where we're finding easy opportunities to invest in or very attractive opportunities to invest in. And as such, we are currently sitting on 16% cash. So starting valuations are very important for investing. You can't just invest at any value. The price you pay for a stock will determine your future performance or your future returns. So we are very mindful of starting valuation, and right now starting valuations are not very attractive, and hence we're sitting on about 16% of cash. So our approach is that we don't mind taking some short term pain if it leads to long-term gain. So, yeah, sitting on some cash and not being fully invested, and if the markets keep rising, you will probably see some short-term underperformance in our fund, and we are okay with that, and we are okay of underperforming in such markets for some time if our longer-term returns will be better over the next 5 or 10 years. We are trying to optimize for long-term returns and not to maximize short-term returns. So yeah, there could be some underperformance, short-term underperformance if the markets continue to rally and we are sitting on 16% cash.
I think as long as the longer term performance works, I don't think it would be a worry for investors. It's a very interesting chat, Neil, but we have to take a quick commercial break. When we come back, we'll continue our conversation with Neil Parekh, the Chairman and CEO of PPFAS Mutual Funds, about the market trends and mutual fund investment strategy as well. Stay tuned for that.
In 1972, a fearless black congresswoman named Shirley Chisholm she ran for president, and her determination let me and millions of others dream bigger, not just because of who she was, but because of who she fought for. Working parents, poor children, the last, the least, and the lost. In 1984, I brought my daughter to see Geraldine Ferraro, the first woman nominated for vice president. If we can do this, Jerry said, we can do anything. And then there was 2016, when it was the honor of my life to accept our party's nomination for president. I wish my mother and Kamala's mother could see us. They would say, keep going. Shirley and Jerry would say, keep going. Women fighting for reproductive health care are saying, keep going. Together, we put a lot of cracks in the highest, hardest glass ceiling. On the other side of that glass ceiling is Kamala
Welcome back. You're still tuned into MF Corner. We still have with us Neil Parekh, the Chairman and CEO of PPFAS Mutual Fund. We're discussing everything about mutual fund investment strategy, the markets in general as well. Neil, you do have investments in global stocks, the US markets, some big names there. How are you looking at global markets in general? Anything which is standing out for you?
So we continue to like the stocks that we hold, and currently we hold only 4 stocks in the global portfolio, which is Alphabet, which is the parent of Google, Microsoft, Facebook, and Amazon. So pretty much the FANG stocks. I think we continue to hold them. We continue to like them. The earnings growth, the business performance of these companies have been phenomenal. Even though they are such big companies, they're growing phenomenally. They're available at a decent valuation also. And most importantly, that some of these companies are the forefront of the digital trends or the tech trends that people are talking about in terms of artificial intelligence and the like, So most of these cloud computing and stuff like that, right? So most of these companies are in the forefront of that, and they are dominant players in that. And we see that they continue to do well for us, and we're pretty excited about having these companies in the portfolio. Unfortunately, for the last couple of years, we've not been able to invest further in global companies because of the RBI limit hit of 7 billion for the whole mutual fund industry. As such, we cannot send more money outside the country to invest in global stocks. So as of right now, these are our 4 best ideas, and we continue to hold them. The only other way we could buy other stocks is if we sell our current position and get something if we think that that's better. But so far, I think we've not found anything better than these stocks. So we continue to hold these stocks, and I think, and hopefully we'll be able to invest further in global stocks in the near future.
Okay, so the tech trends that you're liking, the stocks that you continue to hold on to, that's what's happening globally. The IT boom that continues. But where are the spaces or the sectors in India where you're seeing some margin of safety? IT has made a comeback, private financials have made a comeback. Is this a space that you like?
So we actually, like I said, we like some of the neglected spaces, and one of the big neglected space right now is the private sector banking, They have not really, the private sector banks have not really, participated in this rally as such, and we continue to like them. They take market share from PSU banks on a yearly basis. They are available at attractive valuation, and obviously some of these banks have had some short-term or near-term issues in terms of various reasons. But going for a longer-term horizon for the next 5-10 years, we see private sector banks looking quite attractive at this stage to buy. We are also liking select large cap IT stocks, the IT companies, and select PSU stocks, which again, the dividend yields are also pretty good in some of them. So, and available at a good valuation. So valuations are extremely important to us, like I just mentioned. So some of these where valuations are reasonable, we've been slowly adding some positions there.
Okay.
No,
sorry. Please go ahead. Please go ahead.
Yeah, so otherwise, I think a lot of the sectors or the space in the markets are looking pretty expensive, So it's not something you can just go out there and buy anything and everything. I think you've got to be really judicious about what you're going to buy today. So we are being extremely cautious of what we buy into right now because, like I mentioned, starting valuations are very important to make future profits.
That's extremely true, and something that maybe the markets are not yet pricing in, despite those high valuations that we're seeing. So that caution coming in from you really is important in terms of a market opinion. So in that case, what should the portfolio allocation look like right now? The small and mid-cap frenzy, you think it's behind us? Or as we've been saying, markets are just going through and cutting through all the FOMO that they're talking about?
So clearly small and mid caps have risen quite dramatically over the last few years, and they are again, on an overall scale, they are not very cheap. Obviously selectively you can get some good opportunities there, but putting in again, I think the main thing is that following your asset allocation, And each person's risk will be different, so each person's asset allocation will also be different. So it's hard to give a blanket statement here, but I do feel if someone is overbought in small and mid cap funds or what have you, then I think it's not a bad time to get it back to your asset allocation. Don't be too overbought on these sectors. On the small and mid caps. I think have a longer term approach, but don't be overbought in this space.
Okay, so Neil, something that this is a question we get very often from mutual fund investors, from the retail viewers. What would some of the ways be an investor can start the investment journey with mutual funds? Do they look at a particular category? Is it pure play equity fund? Or should it be a mix of many things? Because at the start, everything looks very confusing.
Yeah, so 3-4 points from my side, and let me just put those out. So I think over these years, when I'm seeing people's portfolios or we're seeing funds, I think more and more in my mind, it's like the problem we have today is over diversification in people's portfolios. That people are buying a lot of funds and a lot of schemes, which doesn't really do anything because the underlying stocks are the same. And the returns are not very optimal, so I think less is more in my view. I think for most people, and this is even for the newer people, the people who are just going to start coming in the mutual fund industry, who are already invested or who are seasoned investors also, I think on a whole, if I have to make a blanket statement, then I'm going to say that you just need to basically 2 diversified mutual funds and 1 probably a large cap index fund, and I think that would do you world of good. I think you can just and the main thing is that a longer term horizon is needed. I think it's very important to know that investing is a marathon, not a sprint. So don't try to sprint. Look at it as a marathon. Look at it over a 5-10 year period. Let the power of compounding work for you. Have patience. Sometimes inactivity is the best activity, and let your just funds grow. You don't need to tinker too much by buying and selling newer funds or something like that. Again, one thing is that you probably don't need so many NFOs that are coming and hitting the market. You need to be really need to study if those actually make sense in your portfolio. If it doesn't, it's okay. Don't buy it out of FOMO or out of your greed or something like that. So just stick to that asset allocation. Have a few funds which you're comfortable with, which have a more of a diversified approach, so they can take advantage of market opportunities as and when they come in various sectors or market caps. That's the one thing I would tell people. Secondly, like like I said, the over diversification in the is I think a big issue. Because people come with 15-20 schemes. One doesn't need so many schemes because, like I said, the underlying stocks are pretty much the same, So be careful about your asset allocation and how many schemes you allocate to. Right. It'll be easier for you to track those schemes. And I think on a whole, where I've seen fewer schemes, those are given better risk-adjusted returns also. So I would say that from the equity point of view. From a debt fund point of view, I think we all know that obviously the taxation changes are here. So a pure debt fund will attract your marginal rate of income tax that you pay. So I would say that one thing that looks attractive to me, or what one should do, is probably look at your longer term or mid to long term debt allocation in hybrid funds, which are debt oriented. Anything less than 1 year, I think liquid funds and arbitrage funds would do the trick. More than 1 year, if you have a time horizon above 1 year in debt funds, then hybrid funds will work well. Anyway, now the long term has come down from 3 years to 2 years. So post 2 years, you'll be getting a good taxation too.
A lot of changes in debt funds. I think that's a different episode altogether. We'll plan that for sure as well, Neil. Such a pleasure having you on the show today. Thank you so much for your expertise on what to do with mutual fund investments in volatile markets like this.
Thank you, Sonal.
Okay, with that, we'll take your leave on MF Corner today, but stay tuned for more news and updates.